Hi, everyone. Thanks for joining Jeff and I this morning. Today, we're going to talk about things that we won't do as a portfolio manager. There is a phenomenon well known in behavioral finance called loss aversion. And some of the Nobel Prize winning psychologists by the name of Daniel Kahneman and Amos Tversky found that the pain of losing, I guess, in a stock psychologically is twice as powerful as a gain. So statistically, I guess people would have to earn 2 to 1 in a gain to feel that they've overcome that loss. So why don't you tell us a little bit about, I guess you ran into a CEO of a company that shared some of his philosophy of investing.
Sure. Yeah, one of the former Canadian bank CEOs he's now retired, was telling me about how he invests his own money. And he was saying that he only focuses on risks so that he can avoid losing money. And then if he's successful in doing that, all of the upside is his. And that's similar to what we do as well. When we're looking at a new investment idea for our clients, most of the time is spent looking at risks to avoid losing money. And that's an interesting study you quote, but I don't need to see any proof because we've all been there. Anytime you buy a
Mhm.
stock and you lose money, it's never a fun experience.
Right. So that leads us to some of I mean, we touch on a lot of companies that we believe in, but there's some companies that we wouldn't, areas, I guess, we wouldn't touch, such as cryptocurrency. Um, Currently, doesn't have a no intrinsic value. Bitcoin, for example, trades on belief, not fundamentals. Really has no cash flow, no underlying business to review. So it's really a speculative area to invest.
Yeah. So we wouldn't touch crypto. Another thing we won't do for clients is use leverage. So that is when you are borrowing money to buy stocks. And this will magnify your returns on the upside, but it can do the same on the downside. If somebody has, say, 100,000 in their account, and that's used as collateral to borrow 200,000, it means you've got 300 grand invested. But if your investments drop by 33%, your whole equity is wiped out. So
Mm,
we don't borrow money to buy stocks. Um,
neither.
Similar to leverage is short selling. That's the exact opposite of owning a stock. So if you buy a certain position and it goes up 10%, you've made 10%. But if you short the same position and the stock goes up 10%, you've lost 10%. So we don't bet against companies. We just avoid buying them. Of course, when you buy a stock, you're limited to your investment as like if a stock goes down 100%, that's your maximum loss. You've lost the amount you put into it. But when you're short selling, your losses are limitless because stocks can go as high as the market trades them. So
Yeah.
we don't short sell either.
And that leads us into like things like over concentrations. So we run into this quite often where clients will transfer or prospects will transfer in assets, and they're over concentrated in a particular sector. So we end up, I mean, diversification is absolutely key for running a efficient portfolio for long-term growth. So we find that, we offer the time to help diversify and invest everything properly for you.
Yeah. Next, options. So these are derivatives. Options have expiration dates on them. And so we don't trade options. They can be used legitimately to manage risk, but we prefer to manage risk through keeping each position size reasonable and as you say in the last section, diversification. So options can go to zero if the market doesn't move in the direction you're hoping by a certain deadline. And so for that reason, we don't get involved with them. We heard a really tragic story not long ago of someone whose family member began trading options with this poor lady's retirement fund, and she said he lost the whole thing.
Yeah.
So options can be really, really dangerous if you
Mhm.
don't know what you're doing.
Mhm.
And last but not least,
Yeah, it's sitting on cash. We find that not fully investing, but almost. If you were to leave too much cash in your portfolio, there could be missed opportunities. So remaining and fully invested is important. We hold high quality companies, um, and spreading among the different sectors is important too for the diversification. So we like to fully invest.
hmm. Okay, so if you're not a client and you want to have somebody give an objective opinion on your portfolio, feel free to reach out to us.
Yeah. All right. Thanks, Jeff.
Okay, thanks, Sunny.